Question 1. The efficiency study reveals that a client's portfolio in California is significantly allocated to sovereign debt issued by various countries. Considering the client's stated moderate risk tolerance and long-term retirement goals, what is the most prudent course of action for the investment advisor? Option A. Advise the client to immediately sell all sovereign debt holdings due to the perceived general instability in global financial markets. Option B. Maintain the current allocation to sovereign debt without further review, assuming historical performance will continue. Option C. Conduct a detailed analysis of the existing sovereign debt holdings, assessing their credit quality, maturity profiles, and the economic stability of the issuing nations, and then propose adjustments to the portfolio to better align with the client's risk tolerance and financial objectives. Option D. Recommend a substantial increase in the allocation to high-yield sovereign debt from emerging markets to enhance portfolio returns. Correct answer is C. Conduct a detailed analysis of the existing sovereign debt holdings, assessing their credit quality, maturity profiles, and the economic stability of the issuing nations, and then propose adjustments to the portfolio to better align with the client's risk tolerance and financial objectives. Explanation. The efficiency study reveals a need to reevaluate investment strategies for a client portfolio heavily concentrated in sovereign debt. This scenario is professionally challenging because it requires the investment advisor to balance the client's stated risk tolerance and financial goals with the inherent risks and opportunities presented by sovereign debt, particularly in the context of evolving economic conditions and regulatory expectations in California. The advisor must navigate the complexities of sovereign risk, interest rate sensitivity, and potential geopolitical impacts without resorting to overly simplistic or misleading advice. The best approach involves a comprehensive review of the client's existing sovereign debt holdings, considering their specific maturity dates, credit ratings, and the economic stability of the issuing nations. This analysis should then be used to recommend a diversified strategy that aligns with the client's stated risk tolerance and long-term financial objectives, potentially including adjustments to duration, credit quality, or geographic exposure. This is correct because it adheres to the fiduciary duty mandated by the Investment Advisors Act of 1940 and California's specific regulations for investment advisors, which require acting in the client's best interest, conducting thorough due diligence, and providing advice tailored to the client's individual circumstances. It emphasizes a proactive and client-centric approach to portfolio management. An incorrect approach would be to recommend divesting all sovereign debt holdings solely based on a general market sentiment that sovereign debt is inherently risky, without considering the client's specific situation or the nuances of different types of sovereign debt. It fails to meet the fiduciary standard by not providing personalized advice and potentially causing the client to miss out on stable income streams or diversification benefits. Another incorrect approach would be to suggest increasing the allocation to higher yield, lower-rated sovereign debt from emerging markets without a thorough assessment of the increased credit and political risks involved, and without ensuring this aligns with the client's stated risk tolerance. This could expose the client to undue risk and violate the duty to recommend suitable investments. A further incorrect approach would be to advise the client to hold onto all existing sovereign debt without any reevaluation, citing the historical stability of certain sovereign bonds. This passive approach ignores the potential for significant changes in economic conditions, interest rates, and creditworthiness that could negatively impact the portfolio, and fails to demonstrate proactive portfolio management and ongoing due diligence. Professionals should employ a decision-making framework that prioritizes understanding the client's unique financial profile, conducting thorough research on all investment options, and clearly communicating the risks and benefits associated with any proposed strategy. This involves a continuous process of evaluation and adaptation, ensuring that all recommendations are both suitable and in the client's best interest, in compliance with California's regulatory environment. Question 2. The control framework reveals that a client in California, invested in a diversified portfolio, expresses concern about how rising interest rates and potential shifts in consumer spending patterns might impact their investments, even though their portfolio is spread across various sectors. As a California licensed investment advisor representative, which of the following actions best addresses these concerns while adhering to regulatory obligations? Option A. Reassure the client that their portfolio's diversification across multiple sectors effectively mitigates all significant investment risks, including those related to interest rates and consumer spending. Option B. Advise the client that their concerns are unfounded given the current market conditions, and that focusing on individual stock performance is more critical than broad economic factors. Option C. Proactively engage the client in a detailed discussion about the nature of systematic risks like interest rate risk and sector risk, explaining how these broad market forces can affect their diversified portfolio and assessing their comfort level with these potential impacts to align expectations and strategy. Option D. Immediately recommend a significant shift to short-term, low-yield government bonds to completely insulate the portfolio from interest rate risk and sector-specific downturns. Correct answer is C. Proactively engage the client in a detailed discussion about the nature of systematic risks like interest rate risk and sector risk, explaining how these broad market forces can affect their diversified portfolio and assessing their comfort level with these potential impacts to align expectations and strategy. Explanation. Scenario analysis. This scenario is professionally challenging because it requires an investment advisor representative in California to navigate the complex interplay between client risk tolerance, portfolio construction, and the inherent systematic risks that can impact investments, even in a diversified portfolio. The representative must demonstrate a deep understanding of how broad market forces, beyond the control of any single issuer or sector, can affect client outcomes, and how to ethically and legally address these risks within the scope of California's regulatory framework for investment advisors. Correct approach analysis. The best professional practice involves a proactive and transparent discussion with the client about the nature of systematic risks, such as interest rate risk and sector risk, and how they can influence the performance of their diversified portfolio. This approach emphasizes educating the client on factors beyond their direct control that can impact their investments, aligning with the fiduciary duty to act in the client's best interest and the California Corporations Code requirements for full disclosure and suitability. It involves assessing the client's understanding and comfort level with these broader market dynamics and adjusting the investment strategy or client expectations accordingly, ensuring informed consent and realistic goal setting. Incorrect approaches analysis. One incorrect approach involves solely focusing on diversification within specific sectors to mitigate risk, without adequately explaining to the client that diversification does not eliminate systematic risks like interest rate fluctuations or broad economic downturns that can affect all sectors to varying degrees. This fails to meet the disclosure obligations and can lead to a false sense of security for the client, potentially violating the duty of care and suitability under California law. Another incorrect approach is to dismiss the client's concerns about systematic risks by stating that their portfolio is already diversified and therefore immune to such factors. This demonstrates a lack of understanding of systematic risk and a failure to engage in a meaningful dialogue with the client about their concerns. It can be seen as a misrepresentation of investment risks and a breach of the fiduciary duty to provide accurate and complete information. A further incorrect approach is to suggest aggressive trading strategies or complex hedging instruments as the sole solution to systematic risks, without a thorough assessment of the client's financial situation, investment objectives, and risk tolerance, and without fully explaining the associated costs and complexities. This could lead to unsuitable recommendations and potential violations of California's regulations regarding investment advice and the prevention of fraud. Professional reasoning. Professionals should adopt a framework that prioritizes client education and transparent communication regarding all material risks, including systematic ones. This involves actively listening to client concerns, explaining complex concepts in understandable terms, and ensuring that investment recommendations are tailored to the client's individual circumstances and risk profile, all within the bounds of California's regulatory requirements. A commitment to ongoing dialogue and reassessment of risk tolerance is crucial. Question 3. Operational review demonstrates that an investment advisor representative in California is preparing to discuss portfolio adjustments with a client who is nearing retirement. The representative has been reviewing various economic indicators to inform their recommendations. Which of the following approaches best reflects a professional and compliant method for integrating economic indicator analysis into client advice? Option A. Advise the client that economic indicators are too volatile and unreliable to be a significant factor in investment decisions, and that only historical performance data should be considered. Option B. Focus exclusively on the latest monthly consumer price index, CPI, report to justify a significant reallocation of the client's assets into inflation-protected securities. Option C. Conduct a comprehensive review of key economic indicators, such as inflation rates, interest rate trends, and employment figures, and integrate this analysis into a personalized recommendation that aligns with the client's financial plan and risk tolerance, clearly explaining the rationale. Option D. Present a strong opinion that a recent slight increase in the Producer Price Index, PPI, definitively signals an impending recession, recommending a complete exit from the equity market. The correct answer is C. Conduct a comprehensive review of key economic indicators, such as inflation rates, interest rate trends, and employment figures, and integrate this analysis into a personalized recommendation that aligns with the client's financial plan and risk tolerance, clearly explaining the rationale. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires an investment advisor representative IR to interpret and apply economic indicators to client recommendations, a core responsibility under the Series 65 exam scope. The challenge lies in discerning which indicators are most relevant and reliable for a specific client's situation, and how to communicate these insights effectively and ethically, avoiding oversimplification or misleading statements. The IAR must balance providing valuable economic context with the fiduciary duty to act in the client's best interest, ensuring recommendations are grounded in sound analysis rather than speculative interpretations of economic data. Correct approach analysis. The best professional practice involves a comprehensive review of various economic indicators, prioritizing those that directly impact the client's investment objectives and risk tolerance. This approach involves understanding the nuances of indicators like inflation rates, interest rate trends, and employment figures, and how they collectively influence market performance and asset classes. The IAR should then integrate this analysis into a personalized recommendation that aligns with the client's financial plan, clearly articulating the rationale and potential implications of the economic environment on their portfolio. This aligns with the Series 65 emphasis on providing suitable advice based on a thorough understanding of economic factors and client circumstances, as mandated by regulations like the Investment Advisors Act of 1940, which requires advisors to have a reasonable basis for their recommendations. Incorrect approaches analysis. One incorrect approach involves solely focusing on a single, highly publicized economic indicator, such as the monthly unemployment rate, to justify a significant portfolio shift. This is professionally unacceptable because it oversimplifies complex economic relationships and ignores other crucial indicators that might present a conflicting or more nuanced picture. Relying on a single data point can lead to recommendations that are not well supported by the broader economic landscape and may not be in the client's best interest, potentially violating the duty of care. Another incorrect approach is to present speculative interpretations of economic data as definitive predictions of market movements. For instance, claiming that a slight uptick in inflation definitively means a particular sector will underperform without further supporting analysis or acknowledging alternative outcomes is misleading. This approach can create unrealistic expectations for the client and exposes the IAR to regulatory scrutiny for making unsubstantiated claims, which is contrary to the ethical obligation to provide accurate and balanced information. A third incorrect approach is to dismiss the relevance of economic indicators altogether, stating that past performance is the only relevant factor for investment decisions. This is professionally unsound because it ignores the dynamic nature of the economy and its direct influence on investment opportunities and risks. Economic indicators provide forward-looking insights that are essential for making informed investment decisions and managing risk effectively, and failing to consider them means the advice provided may not be suitable or prudent. Professional reasoning. Professionals should adopt a systematic approach to economic indicator analysis. This involves 1. Identifying the client's investment goals, risk tolerance, and time horizon. 2. Researching and understanding a range of relevant economic indicators, including their definitions, methodologies, and typical market impacts. 3. analyzing how these indicators interact and influence different asset classes and sectors. 4. Synthesizing this economic analysis with the client's specific profile to formulate suitable recommendations. 5. Communicating the rationale clearly and transparently to the client, including potential risks and uncertainties. This structured process ensures that advice is not only compliant but also robust, client-centric, and ethically sound. Question 4. System analysis indicates that a client in California who has opened an investment advisory account with a registered investment advisor representative is inquiring about the cash balance held within their account, asking if it is similar to a demand deposit account they have at their local bank. What is the most appropriate and compliant response for the investment advisor representative to provide? Option A. State that the cash is available on demand and leave it at that, focusing the conversation on the performance of other investments. Option B. Avoid discussing the cash balance in detail, as it is not actively invested and therefore not relevant to the advisory services provided. Option C. Explain that while the cash is available for withdrawal, it is held within a securities account and is not insured by the FDIC in the same way as a traditional bank demand deposit account, and that its primary purpose is for investment. Option D. Assure the client that the cash balance is essentially the same as a demand deposit account at their bank, offering the same level of security and accessibility. The correct answer is C. Explain that while the cash is available for withdrawal, it is held within a securities account and is not insured by the FDIC in the same way as a traditional bank demand deposit account, and that its primary purpose is for investment. Explanation. Scenario analysis. This scenario presents a professional challenge for an investment advisor representative IR in California because it requires navigating the nuances of client communication regarding account types and the potential implications of different financial instruments. The core difficulty lies in ensuring the client fully understands the nature of their investments, particularly when dealing with instruments that may resemble traditional banking products, but are, in fact, securities. Misrepresenting or inadequately explaining these can lead to regulatory violations and client dissatisfaction. Correct approach analysis. The best professional practice involves clearly and accurately distinguishing between demand deposit accounts offered by financial institutions and investment products that may be held within an investment advisory account. This approach prioritizes full disclosure and client comprehension. Specifically, the IAR should explain that while a brokerage account might hold cash, this cash is not a demand deposit in the banking sense. It is a balance within a securities account, subject to investment risk, and not insured by the FDIC in the same way a bank deposit is. The IAR must clarify that any funds held are part of an investment portfolio and are therefore subject to market fluctuations and the terms of the advisory agreement, and that the primary purpose of the account is investment, not traditional banking services. This aligns with the fiduciary duty under California law and the Investment Advisors Act of 1940, which mandates acting in the client's best interest and providing full and fair disclosure of all material facts. Incorrect approaches analysis. One incorrect approach involves stating that the cash balance in the investment account is essentially the same as a demand deposit account at a bank. This is a regulatory failure because it misrepresents the nature of the funds and the protections afforded to them. Cash held in a brokerage account is not FDIC insured in the same manner as a bank deposit and is subject to investment risks. This misrepresentation violates the anti-fraud provisions of federal securities laws and California's corporate securities law of 1968, which prohibit misleading statements to clients. Another incorrect approach is to simply state that the cash is available on demand without further qualification. While technically true in that the client can request their funds, this statement omits crucial distinctions. It fails to inform the client about the lack of FDIC insurance and the fact that the cash is held within an investment account, not a banking product. This omission of material information is a breach of the duty of disclosure and can lead to client misunderstanding and potential financial harm, violating ethical standards and regulatory requirements for full and fair disclosure. A third incorrect approach is to avoid discussing the nature of the cash balance altogether, focusing only on the investment performance of other assets in the portfolio. This constitutes a failure to address a potentially material aspect of the client's holdings. The client may be under the impression that their cash is held in a traditional, insured banking product, and failing to clarify this can lead to a false sense of security. This silence on a critical detail violates the fiduciary duty to act in the client's best interest and provide complete information. Professional reasoning. Professionals should adopt a framework of proactive and comprehensive disclosure. When discussing account features or balances, always consider what a reasonable investor would need to know to make informed decisions. If a client asks about cash holdings, the professional's duty is to explain not only its availability, but also its nature, the protections, or lack thereof, it has, and how it fits within the overall investment strategy. This involves anticipating potential client misunderstandings and addressing them directly and accurately, always erring on the side of providing more, not less, material information. Question 5. During the evaluation of current economic factors and their potential impact on investment portfolios for a client in California, an investment advisor representative is considering how to best communicate this information. Which of the following approaches demonstrates the most professional and compliant method of conveying economic insights? Option A. Emphasizing the high probability of a severe recession and recommending the immediate liquidation of all equity holdings to preserve capital. Option B. Presenting an analysis of current economic indicators, historical economic cycles, and potential scenarios, while clearly stating that these are not predictions of future market performance. Option C. Detailing past economic downturns and their subsequent market recoveries, suggesting that similar patterns are likely to repeat in the near future. Option D. Expressing a strong conviction that specific industries will experience significant growth due to the current economic climate, advising the client to overweight these sectors. The correct answer is B. Presenting an analysis of current economic indicators, historical economic cycles, and potential scenarios, while clearly stating that these are not predictions of future market performance. Explanation. This scenario is professionally challenging because it requires an investment advisor representative IR to balance the need to provide comprehensive economic insights with the regulatory obligation to avoid making predictions or guarantees about future market performance. The IAR must demonstrate a sophisticated understanding of economic factors without crossing the line into prohibited speculative statements, which could mislead clients and violate regulations. Careful judgment is required to present information factually and objectively. The best approach involves presenting a balanced overview of current economic indicators and their potential implications, while explicitly stating that these are not predictions. This approach is correct because it adheres to the principles of providing factual, objective information without making guarantees or predictions about future market movements, which is a core requirement under the Investment Advisors Act of 1940 and state securities laws, such as those in California. By focusing on historical data, current trends, and potential scenarios, the IAR educates the client without making unsubstantiated claims. Presenting a detailed analysis of past economic cycles and their correlation with market performance, without directly linking them to future outcomes, is an incorrect approach. While educational, it risks implying a predictable pattern that may not hold true, potentially leading a client to believe past performance guarantees future results. This can be interpreted as an indirect prediction or a basis for an unfounded guarantee. Offering a strong opinion on which specific sectors are guaranteed to outperform due to current economic conditions is an incorrect approach. This constitutes making a prediction or guarantee about future investment performance, which is strictly prohibited for investment advisors. Such statements are inherently speculative and can lead to significant client losses and regulatory sanctions. Focusing solely on the potential negative economic impacts and advising clients to liquidate all investments to avoid losses is also an incorrect approach. While risk management is important, making definitive pronouncements about guaranteed losses and advising drastic actions based on such pronouncements can be seen as an attempt to predict future market downturns and can be considered a form of guarantee against loss, which is not permissible. Professionals should employ a decision-making framework that prioritizes factual accuracy, objectivity, and regulatory compliance. This involves understanding the client's risk tolerance and financial goals, then providing information that is relevant to those goals without making speculative statements. The framework should include a constant self-check to ensure that any discussion of economic factors is framed as analysis of current conditions and historical trends, rather than a forecast of future events. When in doubt, err on the side of caution and provide more disclaimers. Question 6. What factors determine the appropriate investment strategy for a client in California when considering the potential impacts of the Federal Reserve's monetary policy and the U.S. Congress's fiscal policy on the broader economy and investment markets? Option A. Dismissing the relevance of both monetary and fiscal policies to individual client portfolios due to their inherent unpredictability. Option B. Discussing with the client how potential changes in interest rates, inflation, and government spending might influence different asset classes and economic sectors, while emphasizing that these are potential impacts and not guaranteed outcomes. Option C. Making definitive predictions about the stock market's direction based on anticipated interest rate hikes by the Federal Reserve and increased government infrastructure spending. Option D. Focusing exclusively on the Federal Reserve's actions regarding interest rates and inflation, while disregarding the influence of congressional fiscal decisions on the economy. The correct answer is B. Discussing with the client how potential changes in interest rates, inflation, and government spending might influence different asset classes and economic sectors, while emphasizing that these are potential impacts and not guaranteed outcomes. Explanation. This scenario is professionally challenging because it requires an investment advisor representative (IR) in California to navigate the complex interplay between monetary policy, fiscal policy, and their fiduciary duty to clients. The IAR must understand how broad economic forces translate into specific investment recommendations without making definitive predictions or guaranteeing outcomes, all while adhering to California's regulatory framework for investment advisors. The core challenge lies in providing informed advice based on economic principles without crossing the line into speculation or misrepresentation. The best approach involves acknowledging the potential impact of both monetary and fiscal policies on various asset classes and economic sectors, and then discussing these potential impacts with clients in a balanced and objective manner. This approach educates the client about the economic landscape and how it might influence their portfolio, empowering them to make informed decisions in consultation with the IAR. This aligns with the fiduciary duty under California law, which mandates acting in the client's best interest, requiring full and fair disclosure of all material facts and avoiding misleading statements. Specifically, California Corporations Code Section 25234 and related rules emphasize the importance of providing advice that is suitable for the client and based on adequate information. Discussing potential impacts, rather than predicting outcomes, is crucial for compliance. An incorrect approach would be to make definitive predictions about the stock market's performance based on anticipated changes in interest rates or government spending. This is professionally unacceptable because it constitutes speculation and potentially misrepresents the certainty of investment outcomes. Such predictions can lead to unrealistic client expectations and violate the duty to provide advice based on reasonable inquiry and analysis, as required by California regulations governing investment advisors. Another incorrect approach involves focusing solely on monetary policy and ignoring the significant influence of fiscal policy on the economy and investment markets. This is a failure of due diligence and comprehensive analysis. California regulations require advisors to consider all relevant factors that may affect a client's investments. Omitting a major economic driver like fiscal policy demonstrates a lack of thoroughness and could lead to incomplete or unsuitable advice. Finally, an incorrect approach would be to dismiss the relevance of both monetary and fiscal policies to individual client portfolios, stating that such broad economic factors are too unpredictable to consider. This is a dereliction of professional duty. While precise predictions are impossible, understanding the general direction and potential impacts of these policies is fundamental to providing sound investment advice and fulfilling the fiduciary obligation to act with the care, skill, and diligence that a prudent person would use in like circumstances, as expected under California law. Professionals should approach such situations by first understanding the current economic environment and the stated objectives of both monetary and fiscal policy. They should then analyze how these policies might reasonably affect different asset classes and sectors, considering both potential positive and negative impacts. This analysis should be framed as potential scenarios and risks, not certainties. The next step is to communicate these potential impacts to the client in clear, understandable terms, linking them to the client's specific financial goals and risk tolerance. The decision-making process should always prioritize transparency, suitability, and the client's best interests, grounded in a thorough understanding of applicable California regulations. Question 7. The monitoring system demonstrates that an investment advisor registered in California is currently recording all client transactions, including the firm's own operational expenses, in a single, consolidated ledger. Furthermore, the recording of client trades is consistently delayed until the end of each fiscal quarter, and the firm relies solely on custodial bank statements to track client asset values without maintaining an independent internal ledger. Which of the following accounting practices best ensures compliance with federal and California securities regulations regarding investment advisor record keeping? Option A. Rely exclusively on custodial bank statements to track client asset values, as these statements are provided by a third party. Option B. Maintain a separate client ledger that accurately and promptly records all client transactions, segregating client assets from the advisor's own funds, and reconcile this ledger with custodial records regularly. Option C. Delay the recording of all client transactions until the end of each fiscal quarter to reduce administrative burden. Option D. Record all client transactions, along with the firm's operational expenses, in a single, consolidated ledger to simplify bookkeeping. The correct answer is B. Maintain a separate client ledger that accurately and promptly records all client transactions, segregating client assets from the advisor's own funds, and reconcile this ledger with custodial records regularly. Explanation. The monitoring system demonstrates a need for robust accounting practices to ensure compliance with the Investment Advisors Act of 1940, as interpreted by the Securities and Exchange Commission, SEC, and enforced by the state of California. This scenario is professionally challenging because it requires an investment advisor to balance the operational efficiency of its accounting processes with the absolute necessity of accurate financial record keeping and client protection. Failure to maintain accurate books and records can lead to significant regulatory penalties, loss of client trust, and reputational damage. The correct approach involves implementing a system that segregates client assets from the advisor's own funds and ensures that all client transactions are recorded accurately and promptly in a dedicated client ledger. This segregation is a fundamental principle of fiduciary duty under federal and state securities laws, designed to protect client assets from the advisor's creditors and to prevent commingling. Prompt and accurate recording ensures that clients have a clear and up-to-date understanding of their holdings and that the advisor can meet its reporting obligations. This aligns with SEC Rule 204-2, A2, and A3 under the Investment Advisors Act of 1940, which mandate the maintenance of accurate and current ledgers and records of all securities received and delivered for the account of clients. An incorrect approach would be to record all client transactions in a single, consolidated ledger that includes the advisor's operational expenses and revenues. This practice violates the principle of asset segregation and creates a significant risk of commingling, making it difficult to ascertain the exact value of client assets and potentially exposing them to the advisor's business liabilities. This directly contravenes the spirit and letter of regulations designed to protect client assets. Another incorrect approach would be to delay the recording of client transactions until the end of the fiscal quarter. This delay introduces a significant risk of inaccuracies due to the passage of time and the potential for errors in recall or data entry. It also prevents clients from having timely access to accurate information about their investments, hindering their ability to make informed decisions and potentially violating the advisor's duty to provide accurate and timely information. This fails to meet the requirement for current records as stipulated by SEC Rule 204-2. A further incorrect approach would be to rely solely on custodial bank statements to track client asset values without maintaining an independent internal ledger. While custodial statements are important, they do not replace the advisor's own obligation to maintain detailed and accurate books and records. The advisor must have its own system to verify the accuracy of custodial statements and to track transactions and positions in a manner that facilitates compliance and client reporting. This neglects the advisor's direct responsibility for record keeping under the Investment Advisors Act. Professionals should adopt a decision-making framework that prioritizes regulatory compliance and client protection above all else. This involves understanding the specific record-keeping requirements mandated by the SEC and state securities regulators, implementing robust internal controls to ensure accuracy and segregation of assets, and conducting regular internal audits to verify compliance. When in doubt, seeking guidance from legal counsel or compliance experts is crucial. Question 8. The monitoring system demonstrates that a publicly traded company whose stock is held in a client's portfolio in California has a debt-to-equity ratio that has recently increased significantly. Which of the following interpretations and subsequent actions best aligns with the fiduciary duty owed to the client? Option A. Analyze the increased debt-to-equity ratio in conjunction with the client's stated risk tolerance and investment objectives to determine if the investment remains suitable. Option B. Inform the client that the debt-to-equity ratio is a technical metric and has no bearing on the suitability of the investment, especially if the client is focused on short-term capital appreciation. Option C. Immediately advise the client to sell the stock, as an increasing debt-to-equity ratio universally signifies an unacceptable increase in investment risk. Option D. Recommend increasing the client's allocation to this stock, assuming the increased leverage will lead to higher returns, regardless of the client's risk profile. The correct answer is A. Analyze the increased debt-to-equity ratio in conjunction with the client's stated risk tolerance and investment objectives to determine if the investment remains suitable. Explanation. The monitoring system demonstrates a need for careful interpretation of financial ratios, particularly when advising clients in California. This scenario is professionally challenging because it requires an advisor to move beyond simple calculation and engage in nuanced analysis that aligns with client objectives and regulatory expectations under California's Investment Advisors Act. The advisor must discern the practical implications of a ratio for a specific client, rather than merely reporting the figure. The best professional approach involves analyzing the debt-to-equity ratio in the context of the client's stated risk tolerance and investment goals. This means understanding that a high debt-to-equity ratio, while potentially indicating higher leverage and risk, could be acceptable or even desirable for a client with a high risk tolerance seeking aggressive growth, provided the underlying business fundamentals are strong and the debt is manageable. Conversely, for a risk-averse client, this ratio might signal an unacceptable level of risk, prompting a recommendation to avoid such investments or to seek further due diligence. This approach is correct because it prioritizes client-centric advice, a cornerstone of fiduciary duty under California law, which mandates acting in the best interest of the client. It also aligns with the spirit of the Investment Advisors Act of 1940, as adopted by California, which emphasizes suitability and a thorough understanding of the client's financial situation and investment objectives. An incorrect approach would be to solely focus on the absolute numerical value of the debt-to-equity ratio without considering the client's specific circumstances. For instance, immediately advising a client to sell an investment solely because its debt-to-equity ratio exceeds a certain arbitrary threshold, without understanding the client's risk profile or the industry norms for that company, fails to meet the standard of care. This is a regulatory failure because it bypasses the crucial suitability analysis required by California regulations. Another incorrect approach is to dismiss the ratio entirely as irrelevant because the client is focused on short-term gains. While short-term focus is a client objective, ignoring leverage can lead to significant downside risk that can derail short-term goals, demonstrating a failure to provide comprehensive advice and a potential violation of the duty to act in the client's best interest. Finally, recommending an investment solely based on a low debt-to-equity ratio without considering other financial metrics or the client's overall portfolio diversification would also be a flawed approach. A low ratio doesn't automatically guarantee a sound investment. It merely indicates lower leverage, and other factors could still present significant risks. Professionals should approach financial ratio interpretation by first understanding the client's objectives, risk tolerance, and time horizon. Then, they should analyze the relevant ratios within the context of the specific investment, its industry, and prevailing economic conditions. The interpretation should always lead to actionable advice tailored to the individual client, ensuring compliance with fiduciary duties and suitability requirements. Question 9. The monitoring system demonstrates a consistent decline in the quick ratio for a company held within a client's California-managed investment portfolio. As a California licensed investment advisor representative, which of the following actions best reflects professional and regulatory compliance in addressing this development? Option A. focus solely on the mathematical trend of the quick ratio, comparing it to industry averages, without considering the specific operational context of the company or of the client's individual financial situation. Option B. Immediately recommend liquidating the client's entire position in the company due to the negative trend indicated by the quick ratio. Option C. Investigate the underlying reasons for the declining quick ratio, assess its impact on the company's short-term financial health and operational stability, and evaluate how this may affect the investment suitability for the client's objectives and risk tolerance. Option D. Disregard the declining quick ratio as a minor fluctuation, assuming it will self-correct without further analysis, and continue with the existing investment strategy. The correct answer is C. Investigate the underlying reasons for the declining quick ratio, assess its impact on the company's short-term financial health and operational stability, and evaluate how this may affect the investment suitability for the client's objectives and risk tolerance. Explanation. Scenario analysis. This scenario presents a professional challenge for an investment advisor representative IR in California because it requires them to interpret and apply the implications of a declining quick ratio for a client's portfolio, specifically concerning the client's ability to meet short-term obligations. The challenge lies in moving beyond a purely mathematical interpretation of the ratio to a qualitative assessment of financial health and its impact on investment strategy, all while adhering to California's regulatory standards for investment advice. The IAR must demonstrate a thorough understanding of the client's financial situation and provide advice that is in the client's best interest, consistent with California Corporations Code Section 25234. Correct approach analysis. The best professional practice involves recognizing that a declining quick ratio, while a quantitative indicator, signals a potential deterioration in a company's immediate liquidity. This approach correctly prioritizes understanding the underlying reasons for this decline and assessing its impact on the company's ability to service its short-term debts and fund its operations. The IAR should then evaluate how this liquidity concern might affect the investment's risk profile and its suitability for the client's objectives, potentially recommending adjustments to the portfolio to mitigate any increased risk or to align with the client's risk tolerance and liquidity needs. This aligns with the fiduciary duty under California law to act with the utmost good faith and to provide advice that is suitable for the client. Incorrect approaches analysis. One incorrect approach is to dismiss the declining quick ratio as a minor fluctuation without further investigation. This fails to acknowledge the ratio's significance as an indicator of immediate financial distress and neglects the IAR's responsibility to thoroughly analyze all relevant financial information that could impact investment suitability. This oversight could lead to providing advice based on incomplete information, violating the duty of care. Another incorrect approach is to solely focus on the mathematical calculation of the quick ratio and its historical trend, without considering the broader context of the company's industry, economic conditions, or the client's specific financial circumstances. While the ratio is quantitative, its interpretation requires qualitative analysis. Ignoring this broader context means the advice may not be truly tailored to the client's situation or the specific investment's risk. A third incorrect approach is to immediately recommend divesting from the investment solely based on the declining ratio, without a comprehensive analysis of the underlying causes or the investment's overall long-term prospects. This reactive approach can be detrimental to the client's portfolio and may not be in their best interest, especially if the decline is temporary or manageable. It bypasses the necessary due diligence required to make informed recommendations. Professional reasoning. Professionals should approach situations involving financial ratios by first understanding the ratio's purpose and what it measures. Then, they must investigate the underlying drivers of any changes in the ratio, considering both internal company factors and external economic influences. This qualitative assessment is crucial for determining the actual risk and impact on the investment suitability. The final step involves integrating this analysis with the client's specific financial goals, risk tolerance, and liquidity needs to provide tailored and prudent investment advice, always prioritizing the client's best interest as mandated by California regulations. Question 10. The monitoring system demonstrates that a California-registered investment advisor representative is reviewing the financial health of a potential investment for a client. The company in question has total debt of $50 million and total equity of $75 million. To provide a comprehensive assessment, which of the following calculations and comparative analyses is most crucial for the representative to perform? Option A. Calculate the debt-to-equity ratio and compare it to industry averages and the company's historical ratios. Option B. Calculate the debt-to-equity ratio and consider it in isolation as a definitive measure of risk. Option C. Use the debt-to-equity ratio to justify a recommendation without further analysis of the company's operations. Option D. Focus solely on the company's revenue growth and disregard the debt-to-equity ratio. The correct answer is A. Calculate the debt-to-equity ratio and compare it to industry averages and the company's historical ratios. Explanation. This scenario presents a professional challenge because it requires an investment advisor representative IR in California to not only understand financial metrics, but also to interpret them within the context of regulatory obligations and client best interests. The debt-to-equity ratio is a critical indicator of financial leverage and risk, and its misinterpretation or misuse can lead to inappropriate investment recommendations, potentially violating fiduciary duties and California's regulatory standards for investment advisors. The IAR must exercise careful judgment to ensure that their analysis and subsequent advice are sound, compliant, and tailored to the client's specific circumstances. The best professional practice involves calculating the debt-to-equity ratio and then comparing it to industry averages and the company's historical performance to assess its financial health and risk profile. This approach allows for a nuanced understanding of the company's leverage. The calculated ratio /frac text total debt text total equity provides a quantitative measure of how much debt a company is using to finance its assets relative to the value of shareholders' equity. A higher ratio generally indicates higher financial risk. By contextualizing this ratio against relevant benchmarks, the IAR can form a well-supported opinion on the company's financial stability, which is crucial for making informed investment recommendations that align with a client's risk tolerance and investment objectives, thereby fulfilling the fiduciary duty mandated under California law. An incorrect approach involves solely relying on the absolute value of the debt-to-equity ratio without considering its context. For instance, a ratio of 1:5 might seem high in isolation, but if the industry average is 2:0 and the company has a history of managing its debt effectively, it may not represent an immediate concern. Failing to perform this comparative analysis can lead to an overestimation or underestimation of risk, resulting in recommendations that are not in the client's best interest. This oversight can be construed as a failure to conduct adequate due diligence, a cornerstone of regulatory compliance for investment advisors in California. Another professionally unacceptable approach is to ignore the debt-to-equity ratio altogether, focusing only on revenue growth. While revenue growth is important, it does not provide insight into the company's financial structure and its ability to service its debt. A company with impressive revenue growth but an unsustainable debt burden is a high-risk investment. This selective analysis neglects a key risk indicator and can lead to recommendations that expose clients to undue financial peril, violating the duty of care and the prohibition against misleading statements or omissions under California's corporate securities law. Finally, an approach that involves using the debt-to-equity ratio to justify a recommendation without understanding the underlying business operations or the client's specific financial situation is also flawed. The ratio is a tool, not an end in itself. Its interpretation must be integrated with a holistic understanding of the investment and the client's profile. Without this integration, the IAR risks making recommendations that are not suitable, potentially breaching regulatory requirements for suitability and client-specific advice. Professionals should adopt a decision-making framework that prioritizes comprehensive analysis. This involves 1. Identifying relevant financial metrics like the debt-to-equity ratio. 2. Calculating these metrics accurately. 3. Contextualizing the metrics by comparing them to industry benchmarks and historical data. 4. Integrating this quantitative analysis with qualitative factors such as management quality and economic outlook. And 5. Ensuring all recommendations are suitable for the client's individual needs, objectives, and risk tolerance, all while adhering to California's regulatory framework for investment advisors. Question 11. Process analysis reveals that a California-registered investment advisor representative is reviewing financial statements for a potential investment opportunity with a client. The statements provided by the company are unaudited. What is the most appropriate way for the IAR to present this information to the client? Option A. Clearly state that the financial statements are unaudited and explain the implications of this lack of independent verification for the reliability of the information. Option B. Provide the unaudited financial statements and state that they are verified, implying a level of assurance without explicitly confirming they are audited. Option C. Assume the client understands the difference between audited and unaudited statements and proceed with the investment discussion without further clarification. Option D. Present the unaudited financial statements and highlight only the positive financial indicators without mentioning their unaudited status. The correct answer is A. Clearly state that the financial statements are unaudited and explain the implications of this lack of independent verification for the reliability of the information. Explanation. Scenario analysis. This scenario presents a professional challenge for an investment advisor representative IR in California because it requires them to balance the client's desire for immediate information with the regulatory imperative for accuracy and transparency regarding financial health. The distinction between audited and unaudited financial statements is critical for investors to understand the level of independent verification and assurance they are receiving about a company's financial position. Misrepresenting or downplaying this distinction can lead to investor misunderstanding and potential harm, violating fiduciary duties and California's regulatory standards for investment advice. Correct approach analysis. The best professional practice involves clearly and accurately communicating the nature of the financial statements provided to the client. This means explicitly stating whether the financial statements are audited or unaudited. If they are unaudited, the IAR must explain what that means, that they have not undergone independent verification by a certified public accountant, and therefore carry a lower level of assurance regarding their accuracy and completeness. This approach aligns with the California Corporations Code, which mandates that investment advisors provide full and fair disclosure of all material facts. Ethically, it upholds the fiduciary duty to act in the client's best interest by ensuring the client makes informed decisions based on accurate information. Incorrect approaches analysis. Providing unaudited financial statements without clearly disclosing their status or implying they have the same level of reliability as audited statements is a regulatory and ethical failure. This misleads the client about the level of scrutiny applied to the financial data, potentially causing them to make investment decisions based on incomplete or unverified information. This violates the principle of full and fair disclosure required by California law. Presenting unaudited statements as if they were audited, even if not explicitly stated, is deceptive and breaches the IAR's fiduciary duty. Similarly, focusing solely on the positive aspects of the unaudited statements while omitting the crucial detail of their unaudited status is a form of omission that can be just as misleading as an outright false statement. Professional reasoning. Professionals should adopt a disclosure-first mindset. When presenting financial information, especially when there's a material distinction like audited versus unaudited status, the primary responsibility is to ensure the client understands the nature and limitations of that information. This involves proactively explaining the implications of unaudited statements, rather than waiting for the client to ask or assuming they understand the difference. This proactive and transparent approach builds trust and ensures compliance with regulatory requirements for accurate and complete disclosure. Question 12. Market research demonstrates that a particular company's stock has a price-to-book ratio that is significantly lower than the industry average. A client who is generally risk-averse and focused on capital preservation asks you, as a registered investment advisor representative in California, if this stock would be a good investment for them. What is the most appropriate way to respond? Option A. Explain that the price-to-book ratio is just one of many metrics used to evaluate a company's stock, and its relevance can vary by industry and company type. You would then discuss how this metric, if at all, relates to the client's specific investment goals, risk tolerance, and overall portfolio diversification. Option B. Recommend the stock immediately, stating that a low price-to-book ratio indicates it is undervalued and therefore a good opportunity for capital preservation. Option C. Advise the client that a low price-to-book ratio signifies strong future growth potential, making it an excellent choice for their investment objectives. Option D. Inform the client that a low price-to-book ratio is an absolute indicator of a stock's value, and that this company is a strong candidate for their portfolio regardless of other factors. The correct answer is A. Explain that the price-to-book ratio is just one of many metrics used to evaluate a company's stock, and its relevance can vary by industry and company type. You would then discuss how this metric, if at all, relates to the client's specific investment goals, risk tolerance, and overall portfolio diversification. Explanation. Scenario analysis. This scenario is professionally challenging because it requires an investment advisor representative IR to interpret a financial metric, price-to-book, P/B, in the context of client suitability and disclosure, rather than simply performing a calculation. The challenge lies in understanding that P/B ratios can be misleading if not contextualized, and that clients' understanding and risk tolerance are paramount. The IAR must avoid making recommendations based on a superficial understanding of a single metric, and ensure that any discussion is transparent and aligned with the client's financial situation and objectives, as mandated by the Investment Advisors Act of 1940 and relevant state regulations in California. Correct approach analysis. The best professional practice involves explaining to the client that the price-to-book ratio is just one of many metrics used to evaluate a company's stock. This approach correctly emphasizes that the P/B ratio's utility varies significantly by industry and company type. For instance, it's more relevant for asset-heavy industries like manufacturing or real estate than for service-based or technology companies with significant intangible assets. Crucially, this approach would then pivot to discussing how this metric, if at all, relates to the client's specific investment goals, risk tolerance, and overall portfolio diversification. This aligns with the fiduciary duty under the Investment Advisors Act of 1940, which requires advisors to act in the best interest of their clients and to provide advice that is suitable. It also addresses the disclosure requirements, ensuring the client understands the limitations and context of any financial metric discussed. Incorrect approaches analysis. Recommending the stock solely because its price-to-book ratio is below a certain threshold, without further analysis or client-specific context, is a regulatory failure. This approach oversimplifies investment analysis and ignores the potential for a low P/B ratio to signal underlying problems with the company, such as declining earnings or poor management. It also fails to consider client suitability, potentially leading to a recommendation that is not aligned with the client's risk profile or investment objectives. Suggesting that the price-to-book ratio is an absolute indicator of a stock's value, regardless of industry or company specifics, is also a significant ethical and regulatory lapse. This demonstrates a lack of professional due diligence and a misunderstanding of financial analysis principles. It can mislead clients into believing a stock is undervalued when it may be appropriately priced or even overvalued based on other factors. This violates the duty to provide accurate and not misleading information. Focusing exclusively on the price-to-book ratio as a measure of growth potential is fundamentally flawed. The P/B ratio is primarily a valuation metric, indicating how the market values a company's assets relative to its book value. It does not inherently predict future growth. Promoting a stock based on this misinterpretation would be a violation of the duty to provide sound investment advice and could lead to unsuitable recommendations. Professional reasoning. Professionals should approach client discussions about financial metrics with a comprehensive and client-centric mindset. This involves 1. Understanding the metric's limitations and its applicability across different industries and company types. 2. Always contextualizing the metric within the client's individual financial situation, investment objectives, and risk tolerance. 3. Prioritizing clear, transparent communication, ensuring the client understands the information and its implications. 4. Avoiding oversimplification or the use of single metrics as definitive buy or sell signals. 5. Adhering to the fiduciary duty to act in the client's best interest, which necessitates thorough due diligence and suitability assessment. Question 13. Quality control measures reveal that a registered investment advisor representative in California is preparing to present a client's financial status for the upcoming year. The representative is considering two methods for presenting this information. one focusing solely on the immediate cash inflows and outflows, and another that accounts for revenues earned and expenses incurred, regardless of when cash transactions occur. Representative needs to determine the most appropriate method to ensure the client makes informed investment decisions. Option A. Present the client's financial status using the accrual method of accounting, as it provides a more comprehensive view of financial performance and obligations. Option B. Present the client's financial status using only the cash method of accounting, as it is simpler and directly reflects the client's immediate liquidity. Option C. Present both the cash and accrual methods side by side without a clear recommendation, allowing the client to interpret the differences. Option D. Present the financial status using whichever method makes the client's overall financial position appear strongest to foster client confidence. Correct answer is A. Present the client's financial status using the accrual method of accounting, as it provides a more comprehensive view of financial performance and obligations. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires an investment advisor representative to navigate the ethical and regulatory implications of presenting financial information to a client. The core of the challenge lies in ensuring transparency and accuracy, particularly when different accounting methods can lead to varied perceptions of financial health. The representative must exercise careful judgment to avoid misleading the client and to uphold their fiduciary duty. Correct approach analysis. The best professional practice involves presenting the client's financial status using the accrual method of accounting. This approach is correct because it provides a more comprehensive and forward-looking view of the client's financial position. The accrual method recognizes revenues when earned and expenses when incurred, regardless of when cash is actually received or paid. This aligns with generally accepted accounting principles, GAAP, and provides a truer picture of the client's economic performance and obligations over a period. For investment advisors registered in California, adherence to ethical standards and regulatory requirements, such as those outlined by the California Corporations Code, mandates providing advice that is in the client's best interest, which includes using accounting methods that offer the most accurate representation of their financial situation for informed decision-making. Incorrect approaches analysis. Presenting the client's financial status solely using the cash method of accounting is professionally unacceptable. While the cash method is simpler and reflects immediate cash flow, it can distort the true financial picture by not accounting for outstanding receivables or payables. This could lead a client to believe they have more or less available capital than they actually do, potentially influencing investment decisions based on incomplete information. This failure to provide a complete financial overview could be construed as a violation of the advisor's duty of care and potentially misleading the client, which is contrary to the principles of ethical financial advice and California's regulatory framework for investment advisors. Another professionally unacceptable approach would be to present both methods without clearly explaining the implications of each and recommending one as the primary basis for financial planning. While offering both might seem thorough, without clear guidance, it can confuse the client and still lead to decisions based on an incomplete understanding of their overall financial health. The advisor's role is to simplify complex financial information and guide the client towards informed decisions, not to present potentially conflicting data without a clear recommendation rooted in the client's best interest. Finally, choosing the method that makes the client's financial situation appear most favorable without regard to accuracy or completeness is a severe ethical and regulatory breach. This approach prioritizes a superficial positive impression over the client's actual financial well-being and informed decision-making, directly violating the fiduciary duty owed to the client and the spirit of California's investment advisor regulations. Professional reasoning. Professionals should adopt a decision-making process that prioritizes transparency, accuracy, and the client's best interest. This involves understanding the client's financial situation comprehensively, selecting the most appropriate accounting method, often accrual for a holistic view, and clearly communicating the implications of that method to the client. When presenting financial information, advisors should be prepared to explain why a particular method is being used and how it contributes to sound financial planning, ensuring the client can make informed decisions based on a complete and accurate understanding of their financial standing. Question 14. System analysis indicates that an investment advisor representative in California, while reviewing their firm's operational procedures, realizes that the firm has recently implemented a new, more aggressive investment strategy for a significant portion of its client accounts. This change was made to potentially enhance returns, but also introduces a higher level of risk. The representative is unsure if this specific shift in strategy, without any client complaints to date, constitutes a material change, requiring an immediate amendment to the firm's Form ADV filing with the SEC. Which of the following represents the most prudent and compliant course of action for the investment advisor representative? Option A. Immediately review the SEC's guidance on Form ADV amendments. If the change in investment strategy is deemed to alter the nature of the services offered or the risk profile presented to clients, file an amendment to Form ADV within the prescribed timeframe. Option B. Assume that change in investment strategy is not a material change requiring an amendment to Form ADV unless it directly leads to a change in the firm's physical office location or the departure of key executive personnel. Option C. Wait to see if any clients express dissatisfaction or raise concerns about the new investment strategy before considering whether an amendment to Form ADV is necessary. Option D. Only consider filing an amendment to Form ADV if a client explicitly requests information about the change in investment strategy or asks for the firm to update its filings. The correct answer is A. Immediately review the SEC's guidance on Form ADV amendments, and if the change in investment strategy is deemed to alter the nature of the services offered or the risk profile presented to clients, file an amendment to Form ADV within the prescribed timeframe. Explanation. Scenario analysis. This scenario presents a professional challenge for an investment advisor representative in California because it requires navigating the nuances of SEC filings, specifically Form ADV, and understanding the implications of material changes. The challenge lies in accurately interpreting what constitutes a material change that necessitates an amendment, balancing the need for timely disclosure with the administrative burden of filing. Misinterpreting this requirement can lead to regulatory violations and damage client trust. Correct approach analysis. The best professional practice involves diligently reviewing the SEC's guidance on Form ADV amendments and applying a conservative interpretation to determine materiality. This means recognizing that any change that could reasonably influence a client's decision to engage or continue engaging with the advisor, or that significantly alters the advisor's business operations, disclosure of conflicts, or disciplinary history, should be considered material. Specifically, the SEC defines material changes to include, but not be limited to, changes in business address, investment strategies, fee structures, disciplinary events, or the addition of new advisory services. A proactive approach to identifying and reporting these changes within the prescribed timeframe, typically 30 days for material changes, is crucial for compliance with the Investment Advisors Act of 1940 and California's specific regulatory requirements for investment advisors. Incorrect approaches analysis. One incorrect approach involves waiting for a significant number of client complaints before considering a change in investment strategy as material. This fails to recognize that materiality is assessed from the perspective of a reasonable investor and does not solely depend on the volume of complaints. The SEC's intent is to provide current information that could influence an investor's decision, and a shift in strategy, even without immediate client dissatisfaction, could represent a material change if it alters the risk profile or nature of the services offered. Another incorrect approach is to only amend Form ADV when explicitly instructed by a client to do so. This is a significant regulatory failure. Investment advisors have an affirmative duty to disclose material information to clients and to the SEC. Relying on client requests for amendments abdicates this responsibility and places the burden of regulatory compliance on the client, which is contrary to the spirit and letter of securities laws. A third incorrect approach is to consider a change in the firm's administrative assistant as an immaterial event, thus not requiring an amendment to Form ADV. While the specific role of an administrative assistant might seem minor, Form ADV requires disclosure of all individuals who provide investment advice or have access to client funds or securities. If the administrative assistant's duties evolve to include aspects of investment advice or access to sensitive client information, this could indeed constitute a material change requiring an amendment. The focus should be on the function and access, not just the job title. Professional reasoning. professionals should adopt a proactive and conservative stance when interpreting SEC filing requirements. This involves staying current with SEC pronouncements and guidance, particularly concerning Form ADV. When in doubt about whether a change is material, it is always best to err on the side of disclosure. Establishing internal procedures for regularly reviewing business operations, client communication, and personnel responsibilities against the requirements of Form ADV is essential. This systematic review process helps identify potential material changes before they become compliance issues. Furthermore, fostering a culture of transparency and ethical conduct ensures that client interests and regulatory obligations are prioritized. Question 15. Risk assessment procedures indicate that a client in California expresses a general comfort with market fluctuations, but has not specifically inquired about company-specific risks. As an investment advisor representative, which of the following actions best fulfills your fiduciary duty and regulatory obligations? Option A. Proactively identify and clearly explain the specific unsystematic risks, such as credit risk and operational risk, associated with any recommended investments, even if not explicitly requested by the client. Option B. Provide a generic disclosure document outlining various types of investment risks, assuming the client will read and comprehend all potential unsystematic risks relevant to their specific portfolio. Option C. Focus solely on the potential for capital appreciation of investments, as this is typically the primary driver of client interest and implicitly covers risk. Option D. Proceed with recommendations based on the client's stated comfort with market volatility, assuming they understand that all investments carry some level of company-specific risk. The correct answer is A. Proactively identify and clearly explain the specific unsystematic risks, such as credit risk and operational risk, associated with any recommended investments, even if not explicitly requested by the client. Explanation. Scenario analysis. This scenario is professionally challenging because it requires an investment advisor representative to balance the client's stated risk tolerance with the inherent, often subtle, unsystematic risks present in specific investments. The client's focus on broad market movements, systematic risk, might lead them to overlook or underestimate risks unique to a particular company or industry, such as a potential product recall or a change in management. A failure to adequately address these unsystematic risks could lead to significant client losses and potential regulatory scrutiny. Careful judgment is required to translate a client's general risk comfort level into a concrete understanding of specific investment risks. Correct approach analysis. The best professional practice involves proactively identifying and clearly communicating the specific unsystematic risks associated with recommended investments, even if the client has not explicitly asked about them. This approach involves a thorough due diligence process to uncover potential issues like credit risk, operational risk, or regulatory risk that are unique to the issuer or asset. By presenting these risks in a clear, understandable manner, the investment advisor representative empowers the client to make an informed decision that aligns with their overall financial goals and true risk capacity. This aligns with the fiduciary duty to act in the client's best interest and the regulatory requirement to provide full and fair disclosure of all material facts, including specific risks. Incorrect approaches analysis. Recommending investments solely based on the client's stated comfort with market volatility, without delving into the specific unsystematic risks of those investments, fails to meet the fiduciary standard. This approach overlooks the critical responsibility to ensure the client understands the unique downsides of each recommendation, not just the general market exposure. Another incorrect approach is to assume that if a company is publicly traded, its risks are fully understood by the client, thereby neglecting the need for specific disclosure of creditworthiness issues or operational vulnerabilities. Furthermore, focusing only on the potential upside of an investment without adequately detailing its specific downside risks, such as the possibility of a bond default or a company-specific lawsuit, constitutes a failure in full and fair disclosure. Professional reasoning. Professionals should adopt a proactive, client-centric approach to risk assessment. This involves moving beyond broad risk categories to a granular understanding of the specific risks inherent in each investment. A structured process should include 1. Understanding the client's stated risk tolerance and financial objectives. 2. Conducting thorough due diligence on potential investments to identify both systematic and unsystematic risks. 3. clearly and comprehensively communicating these identified risks to the client in a manner they can understand. And 4, ensuring the client's decision is based on this complete understanding, not just a general comfort level with market fluctuations. Question 16. Risk assessment procedures indicate that a client in California who has expressed a strong desire to invest in a particular high-risk, speculative technology stock has limited investment experience and a low tolerance for volatility. What is the most appropriate course of action for the investment advisor representative? Option A. Recommend the investment, but include a disclaimer in the client agreement stating that the client was warned of the risks and insisted on proceeding. Option B. Conduct a comprehensive suitability assessment to determine if the requested investment aligns with the client's financial situation, investment objectives, and risk tolerance, and if not, explain the unsuitability and propose alternatives. Option C. Proceed with the investment as requested by the client, as their explicit instruction overrides any concerns about suitability. Option D. Invest a small portion of the client's portfolio in the requested stock to satisfy their request, while investing the majority in more conservative assets. The correct answer is B. Conduct a comprehensive suitability assessment to determine if the requested investment aligns with the client's financial situation, investment objectives, and risk tolerance, and if not, explain the unsuitability and propose alternatives. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires an investment advisor representative to balance the client's stated preference for a specific investment product with their fiduciary duty to recommend suitable investments. The challenge lies in discerning whether the client's request is based on a genuine understanding of their financial situation and goals, or if it stems from incomplete information, emotional bias, or external influence. A failure to adequately assess suitability could lead to regulatory violations and harm to the client. Correct approach analysis. The best professional practice involves conducting a thorough and documented suitability assessment that goes beyond the client's stated preference. This approach requires the investment advisor representative to gather comprehensive information about the client's financial situation, investment objectives, risk tolerance, and time horizon. Based on this holistic understanding, the representative then determines if the requested investment aligns with the client's best interests and regulatory requirements under the Investment Advisors Act of 1940. If the requested investment is not suitable, the representative must explain why and propose alternative suitable investments. This aligns with the fiduciary duty to act in the client's best interest and the regulatory mandate to have a reasonable basis for believing a recommendation is suitable. Incorrect approaches analysis. Recommending the investment solely based on the client's request, without a thorough suitability assessment, violates the fiduciary duty and the reasonable basis provisions of the Investment Advisors Act of 1940. This approach prioritizes client demand over client well-being and regulatory compliance. Another incorrect approach involves proceeding with the investment after a superficial suitability check that doesn't adequately probe the client's financial capacity or risk tolerance. This demonstrates a lack of diligence and a failure to uphold the spirit of the suitability rules. Finally, recommending the investment while acknowledging its potential unsuitability, but proceeding due to the client's insistence, without a clear and documented rationale for overriding the suitability concerns, is also a regulatory and ethical failure. It suggests a willingness to compromise professional judgment for expediency or to avoid client dissatisfaction, which is contrary to the advisor's obligations. Professional reasoning. Professionals should adopt a systematic approach to client recommendations. This involves 1. Comprehensive data gathering, including financial status, objectives, risk tolerance, and experience. 2. A thorough suitability analysis based on the gathered data, comparing it against the characteristics of the proposed investment. 3. Clear and documented communication with the client, explaining the rationale for recommendations and addressing any discrepancies between client preferences and suitability findings. 4. A commitment to acting in the client's best interest, even if it means disagreeing with a client's initial request, and being prepared to justify all recommendations based on regulatory standards and ethical principles. Question 17. The performance metrics show a nominal return of 8% for a client's portfolio over the past year. However, the Consumer Price Index, CPI, in California has risen by 7% during the same period. As a California licensed investment advisor, how should you best communicate this information to the client to ensure full transparency and adherence to regulatory expectations? Option A. Report the 8% nominal return and state that the CPI is a macroeconomic factor that does not directly affect the assessment of investment performance. Option B. Focus solely on the 8% nominal return, assuring the client that this is a strong performance figure and that the CPI is a short-term economic fluctuation. Option C. Explain that while the portfolio achieved an 8% nominal return, the significant increase in the CPI means the real return, or the increase in purchasing power, was considerably lower, and discuss how this impacts their financial goals. Option D. Inform the client that the rising CPI is a concern, but attribute it to external factors without detailing its specific impact on their portfolio's real returns. The correct answer is C. Explain that while the portfolio achieved an 8% nominal return, the significant increase in the CPI means the real return, or the increase in purchasing power, was considerably lower, and discuss how this impacts their financial goals. Explanation. The performance metrics show a significant increase in the Consumer Price Index, CPI, over the past year, impacting the real return of client portfolios. This scenario is professionally challenging because investment advisors in California must ensure their communications and advice are fair, accurate, and not misleading, especially when discussing economic factors that affect investment performance. Advisors have a fiduciary duty to act in their clients' best interests, which includes providing context for performance figures. The best approach is to proactively explain how the rising CPI affects the purchasing power of investment returns. This involves acknowledging the nominal return and then discussing how inflation, as measured by CPI, erodes the real value of those gains. This is correct because it aligns with the fiduciary duty to provide comprehensive and transparent information, helping clients understand the true economic impact of their investments. It directly addresses the client's concern about their money's growth in real terms, fulfilling the obligation to provide advice that is suitable and in the client's best interest under California's regulatory framework for investment advisors. An incorrect approach is to simply report the nominal investment returns without mentioning the impact of the CPI. This fails to provide a complete picture of investment performance and can mislead clients into believing their investments are performing better in real terms than they actually are. This violates the principle of fair dealing and the duty to avoid misrepresentation, which are fundamental to California's investment advisor regulations. Another incorrect approach is to dismiss the impact of CPI as a short-term fluctuation that is not relevant to long-term investment strategy. While short-term volatility is expected, a significant rise in CPI directly impacts the real value of returns and should be addressed, especially if it's a notable trend. Ignoring it can lead to client dissatisfaction and a misunderstanding of their portfolio's true performance, potentially violating the duty of care. Finally, an incorrect approach is to blame the rising CPI on external factors without offering any strategic advice or context for the client. While external factors influence CPI, an investment advisor's role is to help clients navigate these conditions. Simply stating the cause without providing actionable insights or a clear explanation of its impact on their specific portfolio falls short of the professional standard required in California. Professionals should adopt a decision-making framework that prioritizes transparency and client understanding. When economic indicators like CPI significantly impact investment outcomes, advisors must proactively communicate this context. This involves assessing the materiality of the economic factor, considering its direct impact on client portfolios, and then formulating clear, concise, and accurate explanations that help clients make informed decisions. The focus should always be on providing a holistic view of investment performance and its implications. Question 18. Analysis of a client's balance sheet in California reveals a substantial net worth. However, the client has expressed a desire for capital preservation and has a short-term investment horizon. Which of the following actions best demonstrates compliance with California's regulatory framework for investment advisors? Option A. Utilize the balance sheet as a starting point for a comprehensive discussion with the client to understand their income, expenses, cash flow, risk tolerance, and specific investment objectives before making any recommendations. Option B. Recommend a portfolio heavily weighted towards growth-oriented assets, assuming the client's high net worth indicates a capacity for significant risk. Option C. Present the balance sheet to the client as evidence that they are well positioned for aggressive investment strategies, regardless of their stated goals. Option D. Focus solely on the asset side of the balance sheet to identify potential investment opportunities, without considering the client's liabilities or stated objectives. Correct answer is A. Utilize the balance sheet as a starting point for a comprehensive discussion with the client to understand their income, expenses, cash flow, risk tolerance, and specific investment objectives before making any recommendations. Explanation. Analysis of a client's financial situation, particularly when relying on a balance sheet, presents a significant professional challenge for investment advisors in California. The challenge lies in interpreting the static snapshot of assets and liabilities to understand the client's true financial capacity and risk tolerance, which are dynamic and influenced by many factors not explicitly detailed on the balance sheet itself. A balance sheet, while crucial, is only one piece of the puzzle. Investment advisors must exercise careful judgment to avoid making recommendations based on incomplete or potentially misleading information. The best approach involves a comprehensive review of the balance sheet in conjunction with other vital client information. This includes understanding the client's income, expenses, cash flow, investment objectives, time horizon, and risk tolerance. A balance sheet provides a snapshot of net worth, but it doesn't reveal liquidity, the nature of assets, e.g., readily marketable versus illiquid, or the stability of income streams. Therefore, the most responsible action is to use the balance sheet as a foundational document and then engage in a thorough discussion with the client to gather the necessary qualitative and quantitative data to form a holistic financial picture. This aligns with the fiduciary duty and the California Corporations Code, which requires investment advisors to act in the best interest of their clients and to have a reasonable basis for any investment recommendation. An incorrect approach would be to solely rely on the balance sheet to assess a client's investment capacity without further inquiry. This fails to acknowledge the limitations of a balance sheet in reflecting a client's ability to absorb losses or their ongoing financial needs. Such an approach could lead to recommendations that are unsuitable for the client's actual circumstances, potentially violating the California Corporations Code's mandate for suitability and the advisor's fiduciary obligations. Another incorrect approach is to present the balance sheet as a definitive indicator of investment success or failure. A balance sheet is a historical document reflecting past financial activity and current net worth. It does not predict future investment performance. Basing recommendations on such a projection without considering market conditions, economic outlook, and the client's specific goals is speculative and unprofessional. Finally, an incorrect approach is to interpret the balance sheet in isolation without considering the client's stated investment objectives. A client with a high net worth shown on a balance sheet might still have very conservative investment goals, or vice versa. Ignoring stated objectives in favor of what the balance sheet might superficially suggest is a failure to understand and serve the client's needs, which is a direct contravention of ethical and regulatory standards. Professionals should adopt a decision-making framework that prioritizes a deep understanding of the client's entire financial situation, not just a single financial statement. This involves active listening, thorough data gathering beyond the balance sheet, and a continuous assessment of suitability and client best interests, all within the framework of California's regulatory requirements for investment advisors. Question 19. The review process indicates that a New York-registered investment advisor is considering recommending a specific certificate of deposit (CD) to a client. The client has expressed a strong preference for preserving capital and needs access to the funds within approximately 18 months for a planned home renovation. The advisor has a business relationship with a particular financial institution that offers a CD with a slightly higher interest rate than other available options, and the advisor anticipates receiving a small administrative fee from this institution for facilitating the transaction. What is the most appropriate course of action for the investment advisor? Option A. Recommend the CD after confirming its suitability for the client's short-term capital preservation needs and access requirements, and providing full written disclosure of the administrative fee to the client. Option B. Recommend a different, highly liquid investment like a money market fund, even if it offers a lower yield, to completely avoid any potential for perceived conflicts of interest. Option C. Recommend the CD because it offers a slightly higher interest rate and is a low-risk product, assuming the client will understand that advisors are compensated for their services. Option D. Recommend the CD without disclosing the administrative fee, as it is a standard practice for advisors to receive fees for facilitating transactions with financial institutions. The correct answer is A. Recommend the CD after confirming its suitability for the client's short-term capital preservation needs and access requirements, and providing full written disclosure of the administrative fee to the client. Explanation. The review process indicates a potential misinterpretation of the regulatory requirements concerning the disclosure of material facts and the duty to act in the client's best interest. Investment advisors in New York, operating under the New York Business Corporation law and relevant regulations, are obligated to provide advice that is solely in the best interest of their clients. This includes a fiduciary duty to disclose all material information that could reasonably be expected to impair their independent judgment or influence their investment recommendations. The correct approach involves a comprehensive evaluation of the certificate of deposit CD for suitability based on the client's specific financial situation, investment objectives, and risk tolerance. This means considering factors such as the CD's interest rate, term, liquidity, and any associated fees or penalties in relation to the client's stated need for funds within a specific time frame. Crucially, if the advisor receives any form of compensation, commission, or referral fee for recommending a particular CD, this must be fully and clearly disclosed to the client in writing, prior to or at the time of the recommendation. This disclosure allows the client to understand any potential conflicts of interest and make an informed decision. An incorrect approach involves recommending a CD solely because it is a low-risk product, without a detailed suitability analysis for the client's specific needs, and failing to disclose the referral fee. New York regulations require advisors to act as fiduciaries, meaning they must place their clients' interests above their own. A referral fee creates a conflict of interest that must be disclosed. Assuming the client understands such arrangements is not a substitute for explicit, written disclosure. Another incorrect approach is to recommend a CD based on the advisor's personal preference for a particular bank or a desire to avoid the administrative burden of disclosing a referral fee, even if the CD is suitable. The primary consideration must be the client's best interest, and any potential conflicts must be managed through disclosure and adherence to suitability standards. Finally, recommending a CD without a clear understanding of its terms and how they align with the client's short-term liquidity needs is a failure of due diligence. While CDs are generally safe, their specific features, such as early withdrawal penalties, could negatively impact a client needing access to funds for a down payment within 2 years. Professionals should approach such situations by first identifying any potential conflicts of interest arising from compensation or relationships with product providers. They must then conduct a rigorous suitability assessment for the client, ensuring the recommended product aligns with their stated objectives, risk tolerance, and time horizon. All material facts, including any compensation received by the advisor, must be disclosed transparently and in writing. The decision-making process should be documented, demonstrating that the recommendation was made in the client's best interest. Question 20. Performance analysis shows a significant upward trend in prevailing interest rates across the U.S. Treasury market. A client portfolio managed by a California-registered investment advisor holds a diversified mix of corporate bonds. To best advise the client on the potential impact of these rising rates, which of the following valuation factors should the advisor prioritize for quantitative analysis? Option A. The current yield to maturity of individual bonds. Option B. The credit ratings of the bond issuers. Option C. The weighted average duration of the portfolio. Option D. The coupon rates of the bonds held in the portfolio. The correct answer is C. The weighted average duration of the portfolio. Explanation. Scenario analysis. This scenario presents a common challenge for investment advisors registered in California, requiring them to accurately assess the impact of changing interest rates on a client's fixed income portfolio. The challenge lies in moving beyond simple yield calculations to a more sophisticated understanding of interest rate sensitivity, which is crucial for providing suitable investment advice and managing risk. Failure to correctly interpret these valuation factors can lead to misinformed recommendations, potentially exposing the client to undue risk or missed opportunities and violating fiduciary duties. Correct approach analysis. The best professional practice involves calculating and analyzing the portfolio's duration. Duration measures a bond's price sensitivity to changes in interest rates. A higher duration indicates greater sensitivity. By calculating the weighted average duration of the portfolio, the advisor can quantitatively estimate the potential percentage change in the portfolio's value for a given change in interest rates. For example, a portfolio with a duration of 5 years would be expected to decrease in value by approximately 5% if interest rates rise by 1%. This approach directly addresses the core valuation factor of interest rate risk and provides a quantifiable basis for advising the client on portfolio adjustments. This aligns with the fiduciary duty under California Corporations Code Section 25,234, which requires investment advisors to act in the best interest of their clients and to provide advice that is suitable based on the client's financial situation and investment objectives. Incorrect approaches analysis. One incorrect approach is to solely focus on the current yield-to-maturity (ITM) of individual bonds. While YTM is an important metric, it represents the total return anticipated on a bond if held until maturity, assuming all coupon payments are reinvested at the YTM. It does not directly measure price sensitivity to interest rate fluctuations. Relying solely on YTM would fail to account for the significant risk that bond prices will fall as interest rates rise, potentially leading to a misrepresentation of the portfolio's true risk profile and violating the duty of care. Another incorrect approach is to simply observe the coupon rates of the bonds. Coupon rates determine the periodic interest payments received by the bondholder, but they do not directly reflect how the bond's market price will change in response to interest rate movements. Bonds with higher coupon rates may be less sensitive to interest rate changes than those with lower coupon rates, but this is a secondary effect and not the primary driver of price volatility. Focusing only on coupon rates ignores the fundamental relationship between bond prices and prevailing interest rates, thus failing to provide comprehensive valuation advice. A further incorrect approach is to look at the credit ratings of the bonds without considering interest rate sensitivity. Credit ratings assess the likelihood of default by the issuer. While important for understanding credit risk, they do not directly address the market risk associated with changes in interest rates. A high-rated bond can still experience significant price depreciation if interest rates rise substantially. This approach neglects a critical valuation factor for fixed-income securities and would not fulfill the advisor's obligation to provide advice considering all relevant risk factors. Professional reasoning. Professionals should adopt a systematic approach to portfolio analysis. This involves understanding the various valuation factors of fixed-income securities, including yield, maturity, coupon rate, credit quality, and crucially, interest rate sensitivity, duration. When interest rates are a significant market factor, as indicated by performance analysis, the advisor must prioritize metrics that quantify this risk. Calculating and interpreting duration allows for a proactive and informed discussion with the client about potential portfolio performance under different interest rate scenarios, enabling the client to make well-reasoned decisions aligned with their risk tolerance and investment objectives. This comprehensive analysis is essential for fulfilling regulatory obligations and maintaining client trust.